Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering 5 stocks with ex-dividends November 6th through November 10th. So this is a weekly release that comes out every single Wednesday, and I'm actually excited because today I wrote up this article, released it earlier today, and then shared it off on Facebook. So here I have the statistics just from today. So on October 31st, happy Halloween everyone, I had 52 views. 26 of them came from Facebook, and then the other half, the other 26 came from miscellaneous areas outside on the web. So here we can see that 31 views went straight to the 5 stocks with ex-dividends November 6th through November 10th, and then I had a couple on my homepage and on the previous week, and then so on. So I had a total of 52 today, which is actually the highest view count I've had on a single day on my website. So that's actually very interesting and kind of exciting because 3 months on YouTube now and 3 months with my website. So this is just a continuous thing. I am working to improve both my content, my website, and all the information that I'm able to provide. I'm looking to add a couple videos on dividend terminologies and such because I am a dividend investor. I find that that's the main area I should speak on besides just stock market in general and in just investing in what I know. So I will definitely be coming out with some new content, both covering just general investing, the stock market, and dividends. So that is coming up in the future. Of course, if you are brand new to my channel, I do make financial, stock market, and investment videos weekly, so do consider subscribing for future financial videos. So let's go ahead and jump into this. So I have 5 stocks with ex-dividends next week. These have been picked out randomly. I do own one of them, which I'll go ahead and say once we get to that stock, or you can take a pick which one it is. The current stocks that we are covering today is RGA, Reassurance Group of America. I have SON, Sonoco Products. I have IBM, International Business Machines. I have Pfizer, PFE, which is Pfizer. It's a pharmaceutical company. And I have GWW, which is WW Granger. And all 5 of those have ex-dividends next week. So here, RGA is a reinsurance group of America which engages in individual life asset intensive critical illness and financial reassurance in the United States, Canada, Europe, South Africa, and Asia Pacific. So it's very diversified, not only nationally but internationally. So I found this stock very interesting when I was kind of looking into it. This one piqued my interest out of the 5. So go ahead and let me know at the very end in the comments which of these 5 kind of piqued your interest. So this one has an ex-dividend date of 6th November, which is next Monday. So you would have to pick this stock up on Friday or prior. The pay date would be 28 November. So this one actually has the ex-dividend and the pay date within the same month in November. Its dividend payment is 50 cents per share. So if you had 10 shares of this stock, you would get paid $5 every quarter for a yearly return of $20. So 5. That would be $20 for just 10 shares, and that would cost you about $1,490. So not too bad of a turnaround, even though the yield appears low in this picture here at 1.10. They just increased their dividend from 0.41 per share per quarter to 50 cents per share per quarter, which is about a difference of about 8 or 10%, just kind of estimating that math there. Their stock price is $149.07. Their price to book value is 1.18, so you're paying a slight over premium. If you're paying a 1-for-1, that would mean that you're paying the current price that it's trading at is at 100% of what the book value of the company is actually worth. So in most cases, if you get a 1.0 book to price to book value, the price that you're paying for the stock is the exact price of the book value of the company. So that is the price to book value, and that's why I'm kind of including it going forward in my 5 stocks with ex-dividends next week. So here we see that RGA, when charted, it shows that the current stock has a higher price to yield, which would indicate it is overvalued at this time. Now, when I wrote this up, I saw that the price was higher to the compared to the yield, but they bumped up. See this line right here? This used to be the 41-cent point for their dividend payment. It bumped up to 50 cents. So actually, this stock here is actually very balanced and priced. Its dividend payment per share is right along the line with the stock price, and it's also right along the line with what the dividend yield would be and what the price to book value would be. So it's very, very valued at this time. It's not undervalued, it's not overvalued, it's actually very valued for what you're paying for the company. You're essentially almost getting what you're buying it for is what you're actually paying for the assets that it has. Let's see here. So number 2, stock is over in the industry, but under in the sector price to earnings average. It is below 60% payout ratio, and it's had dividend growth for the past 6 years. Its price to book value is 1.18, which is under 3, indicating it could be a good value. So I use the word could and could not be a good value. I couldn't really come up with better terminology, because it's always best to look up stocks that are under 3 book value, because Warren Buffett thought that stocks underneath a 2.5 or 3 book to price to book value were considered value investments, but of course it's not always the case. Sometimes if they have a price to book value that is underneath 3, it could mean that something is fundamentally wrong with the company, and some of their assets and liabilities could just be kind of shooting out everywhere. So you definitely want to do your research with any of the information that's provided here and just provided everywhere, anywhere in general. You always want to dig a little bit deeper and look into the company for yourself. The stock price to earnings is pretty low, 12.29. The industry is 0.94, and the sector is 16.43. So the industry, I could not find what industry this company is actually in. The sector was reinsurance sector, and that's actually in my resources. If you open this up here, and it's going to take a little bit. I'm going to come back to that. It looks like it's loading still. I added a new link in there which has all of the sector price to all the price to earnings PE ratios. Price to earnings ratio, yeah, it has all of that in there. So now it loaded. So we scroll down here towards the bottom, and we have the PE ratio per sector. So if we click on that, this website's going to pop up, and it's going to have all the PE ratios by sector. And right here we can see what the current PE of each specific sector is. So if we were to look at 16.43, it may not be completely accurate, but we can look up 16.4, and so reinsurance right here is sitting in the 16.41 sector. And I may have goofed up on the following ones, because I noticed that the sectors for these other ones all say 16.43, when I know that the price to earnings ratio is not going to be 16.43 or 16.41 for those specific ones. So that is something I do need to fix still. So we already covered their dividend yield. It bumped up to 1.34, so this is where I was saying the current dividend yield here shows 1.10 on this graph. The actual dividend yield is 1.34, which would be right about here, which would still put the stock price above the current yield, but the company itself is very valued at this time. They pay out $2 per share for every share that you have annualized. Their payout ratio is 18.6, which is less than Apple's payout ratio. They have had dividend growth for 6 years. So similar to Apple, Apple's payout ratio is around 21%. Their dividend growth, I believe, is around 5 to 6 years. So this company is very similar to Apple, but of course they don't have the same revenue and market capitalization as Apple. I just thought it was an interesting stock. I'm still kind of looking into this one. So let's go ahead and cover the next stock, and that is SON, and that is Sonoco Products. And it manufactures industrial and consumer packaging products and packaging services primarily in the United States, Europe, and Canada. It offers a variety of products. You can go ahead and pause the video and read every single one of those things off, because that is a ginormous list of information that they, um, packaging products that they actually do. So they do a great number. Their ex-dividend date is on 9 November, which is next Thursday. That means you need to pick up the stock on Wednesday or prior. You would then get paid out on 8 December. This stock pays 39 cents per share. So if you picked up 10 shares of it, you would get paid $3.90 per quarter, or let's see, about $15.60 for the year. Their current price of the stock is $51.79, and their current yield is 2.93. Their price to book value is 2.9. So when charted above, it shows that the current stock does have a higher price to yield, which would indicate it is overvalued at this time. The stock is under in the industry, but over in the sector price to earnings average. It is below 60% payout and dividend growth for the last 36 years. So I would consider this specific stock very recession proof. Price to book value is 2.92, which is under 3, indicating it could be a good value. The stock price to earnings ratio is 19.06, the industry is 26.47, and the sector could be incorrect. I'd have to look back and review that. Don't take my word for that sector. I believe I had copied and pasted. I got trigger happy and just copied and pasted a little bit too much. Dividend yield was correct up here. It's sitting at 3.01 today when I copied the information and got the information out from Google. Annualized payout is $1.56 per share. So if you have 10 shares, that is $15.60. Their payout ratio is below 60%, so they're at least reinvesting 45% of their earnings back into their company. Their dividend growth has been for 36 years. So this company here, Sown, is very, they're doing industrial and consumer packaging products, so very recession proof, and they have a ginormous list of products. So this would be an interesting one if you're looking for something in the consumer. We can see here, consumer. They have different consumer areas here, probably just those two. So business and consumer services. So their current PE ratio in that specific sector could be a little bit higher. Could be one of these other ones, but definitely want to look into that. And let's see here, we covered that information, we covered that. And the next stock is IBM, International Business Machines. Of course, this one provides information technology products and services worldwide. They operate in 5 segments, and these are global technology services, global business services, software, systems and technology, and global financing. So very diversified there as well, and they're global, so they're international. Their ex-dividend date is on 9 November, which is next Thursday. You would need to buy and own the stock on Wednesday and hold it until Thursday. You could then sell it off then and still get the dividend payment for the following month in 9 December. But this stock is actually at a pretty good buy. We see here that they pay $1.50 per share per quarter. They have a yield right now sitting at 3.77. It was actually 3.9 when I pulled this information today. Their share price is $153, which is at a low point. They actually had a low point down here. They were in a $142 range at a couple weeks ago, back in September, and that would have been a great opportunity to buy, where their yield had actually exceeded 4%. Their price to book value here is 7.26, so you're basically paying a 726% premium for their stock to their assets. Their price to book, what their book value is worth in comparison to their current price. So IBM, when charted, it shows that the current stock price does have a higher yield to price, which would indicate it is undervalued at this time. The stock is under in the industry and in the sector price to earnings average. It is under 60% payout ratio, and has had dividend growth for 17 years. So why would you consider this semi-recession proof? Meaning that back in the 17 years ago was Y2K, or the 2K bubble, so that's when this company had stopped increasing their dividend, but it still survived through the 2008-2009 housing and kind of financial bubble that took place there. So this one, it could, I don't believe it would have a negative effect. We're probably not going to go into like another tech bubble. We probably already learned our lesson through that. So Let's go see what the future lays ahead of us. So price to book value, we already talked about 7.26. So you're basically paying a 726% premium for the price to book value that is currently worth, which is over 3, indicating it could not be a value. That's up to you. I wrote couldn't be a value buy. The stock is 12.84, the industry is 20.42, and the sector is probably incorrect, so don't worry about that. Its dividend yield is 3.90 when I pulled this information. Its annualized payout is $6 per share. So if you have 10 shares of this stock, 10 times 6 is $60 for the year, or $15 per quarter. Its payout ratio is 43.5, so it's well under the 60% ratio that I like to buy. So they're reinvesting about 57% of their earnings back into their company. So, and they have room to grow their payout ratio up and pay out a little bit more. Excuse me. Their dividend growth has been for the last 17 years. So this company is very well set. They're semi-recession proof. They have a very low payout ratio, and they could definitely raise the payout ratio in the future to continue their dividend growth, even during times of recessions and just market woes. The next stock, number 4, is ticker symbol is PFE, and this is Pfizer. Of course, this is a research-based global biopharmaceutical company. The company operates in 5 segments: primary care, specialty care, oncology, established products and emerging markets, animal health and consumer healthcare, and nutrition. So very diversified. Again, this is actually one stock that is in my portfolio, and that is Pfizer. Its ex-dividend date is on 9 November, which is next Thursday. So of course you need to buy the stock on Wednesday or prior. You would then get paid out on 1 December. They pay out 32 cents per share per quarter. Their stock price is $34.96. Their price to book value is 3.5, and their current yield is 3.6. So Pfizer, PFE, when charted, it shows that the current stock has a higher price to yield, which would indicate it is overvalued at this time. The stock is under in the industry, but over in the price to earnings ratio, price to earnings average. It is sitting below 60% payout and has had dividend growth for the past 7 years. The price to book value is 3.56, which is over 3, indicating that it could not be a value buy at this time. The stock price to earnings ratio is 25.48. Industry average is 30.6, and the sector average is probably incorrect again. The dividend yield is 3.67% right now, which is very nice. I actually bought it when it was near I bought mine back in August timeframe. So right here, when the yield was exceeding the price, that's when I bought into the stock. I'm actually up about 27%, I bet. Somewhere in that range. So it was a very good buy at that time when I saw it was undervalued at the time. And the AbbVie was the other one I had bought with the pharmaceuticals. Anyways, let's see here. Where are we at? We talked a little bit about their payout ratio, 50%. They're reinvesting 50% of their earnings back into their company. They pay out $1.28 per share. So if you had 10 shares, you would get paid out $12.80 for the year, or about $3.20 per quarter. Their dividend growth, of course, is 7 years, so they haven't paid out or continue to pay out through a recession. The number 5 ticker symbol, number 5 ticker symbol is GWW, and this is WW Grainger Engages. So WW Grainger, so they engage in the distribution, maintenance, repair, and operating supplies, as well as other related products and services for the business and institutions, primarily in the United States and Canada. So they include small and medium-sized businesses to large corporations, government entities, and other institutions. So looks like they do a lot of maintenance, repair, and operating supplies for a lot of different size companies. So their ex-dividend date is on 10 November, which is next Friday. You would need to buy the stock Thursday or prior. You would then get paid out on the 1st of December. They pay out $1.28 per share per quarter. Their dividend yield is 2.52. Their stock price is $198.34, and their current price to book value is 6.39. When charted, it shows that the current stock has a higher yield price, which would indicate that it is undervalued at this time. The stock is under in the industry but over in the sector PE average. It is below 60% payout and has dead dividend growth for 45 years. I would consider this one recession proof. Its price to book value is 6.39, which is over 3, indicating it couldn't be a value. You would definitely want to look at the history of the price to book value. It looks like the price to book value back in January through April was up in the 8.2s. It has just recently fell down into the 5.6 range and then kind of trailed back up. So this price to book value stays pretty consistent with the stock price, and you can see here generally you can see that this price to book value back on IBM here was actually very high over the price, whereas some of the other stocks here, this stock for instance here, this is Son, its price to book value is actually sitting below the price of the stock. So that's a good indicator that the price that you're paying for, you're getting a pretty good value for it, even though it's 2.98, which is the premium, 292% premium price. You're probably getting a very good price, and it's very recession proof. So that could be one to consider looking to add to your portfolio, or just kind of add for your ex-dividend. Let's see here. So we already covered the price to book value is a bit high, and I think I read over that and talked about how it's recession proof. So price to book, price to earnings, PE ratio is 23.52. The industry is 26.52, and the sector is 16.43, but that's probably incorrect once again. So I have to go back and look at the sectors on these specific ones and kind of change them up to make sure I'm actually adding the correct information in there. So the dividend yield is currently 2.58. They pay out $5.12 per share. So if you owned 10 shares of these, that would be around $2,000, and you would get paid out, what would that be, $51 per share? Or wait, boy, I cannot do the math on that right now. I think it would be $50. 5.2 times 10 shares, 5.12 times 10 is $51.20. So, and 10 shares of 198.34 times 10 would be, $2,000 for $51 in dividend income per year is not a bad, especially, I don't think this one was super diversified, but it's definitely had dividend growth for the past 45 years, so it's very recession proof. And its price to book, or its payout ratio, is very low. It's 48%, so they're reinvesting 50% or more of their earnings back into their company and growing it up. So that is it for this video. I know it's a lot of dry information at times. I hope, or I wish there was a way I try and make it a little bit funner. That's why I make the article itself. That way, if you don't want to sit through the dull sort of reading it off the site, you could always check it out online. And I think it's a little bit faster this way. We're sitting at 22 minutes and 53 seconds, so I think I cover a lot more information, just kind of going pre-writing it on the website and kind of sticking it up there and then covering it in a video instead of having to scroll through multiple different websites and gather the information at the same time that I'm sort of trying to look up the specific stock. So that is it for this video. I want to thank every single one of you guys out there that have watched the video up until this point. If you did enjoy the video, remember to hit the like button below. If you are brand new to my channel, remember to subscribe for future financial videos. If you did like the video or the article, remember to check out the website. It will be in the description below. If you like the page, please share it with any of your friends that are interested in dividend investing or are interested in investing in general. So that is it for this video. Thanks for tuning in, and I will see you next time. Bye.